Sadine Nigaro is an equity analyst who is evaluating Piron Corp. The firm is a public limited company that manufactures lifeboats. So we've got some financial information here: assets, liabilities, revenue, shares outstanding, and market cap. From the data given above, the difference between the per share market value of equity and the per share book value of equity is closest to. So per share market value of equity is going to be pretty straightforward. That'll be our market cap divided by number of shares. And then for book value, we're not given that number. However, it's just going to be our assets minus our liabilities. So there's going to be a couple steps to this calculation. Let's pull in the numbers. So our book value, pretty straightforward. It's going to be assets minus liabilities. So that gives us a book value of $350 million. And then to find the difference in the per share amount, we'll take the market cap value, which is 393,750 million, and then subtract out 350 million. So that gives us a difference of almost 44 million. And then we divide that by shares outstanding of 8.75 million, and that gets us to 5. So this is going to be our difference in per share market value and per share book value. And we see that lines up right there with answer A. A company is experiencing a decrease in market share due to the introduction of cheaper substitute products. As an analyst, you are tasked with forecasting the company's financials. How would you most likely expect this market situation to impact the company's gross margin? The gross margin is likely 2. So gross margin, just a level set, is going to be our sales minus cost of goods sold. And so those are going to be the two main inputs here. So the gross margin is likely to increase, decrease, or remain the same. So in this instance, we have cheaper substitute products coming in, meaning that these companies or new products are coming in at a lower price point. And so for our company, what this is likely going to do is our sales are going to decrease because we're probably going to have to come down on our price to meet these cheaper substitutes in order to keep our market share, or get our market share back up, because we were seeing decreasing market share. So unless we're able to find a way to also decrease our cost of goods sold, which is going to be unlikely, our gross margin is going to be most likely to be decrease, since we're going to have decreasing sales per unit, but cost of goods sales will likely be flat. So that's going to lead to our margin compressing. Answer B. Based on Porter's 5 forces analysis, which of the following is least likely to influence the profit potential of an industry? So we've got intensity of advertising campaigns, B, threat posed by potential new entrants, or C, collective economic power of customers. So 2 of these are going to be likely to influence our profit potential, and 1 is not, which is why we have this least likely. So looking at these 3, collective economic power of customers, this changing would have an influence on our profit potential. If the customers have more economic power or less economic power, that's going to determine or change how much we can charge. And so if we can charge more or less, that's obviously going to have an effect on our profits. B, threat posed by potential new entrants. This is also going to have an effect on profits. If it's easy for new entrants to come in, and if they come in with good products, then we may have to charge less in order to stay competitive. And so if we're having to charge less for the same product, then that's going to obviously drive down our profit. And then that's going to leave A as our answer. Intensity of advertising campaigns. This isn't necessarily changing the industry dynamics. It could change the market share that we have and how we position our company relative to competitors, but it shouldn't really change the price that we can change just because we're more intensely marketing. Answer A. Which of these is most likely the major focus of a portfolio manager under the efficient market hypothesis? A, diversify the portfolio. B, follow a strict buy and hold strategy. Or C, reduce the systematic risk to a minimum. Reducing systematic risk is not going to be our best option. We want systematic risk because we want the market risk. We're going to want to reduce unsystematic risk if we believe in efficient market hypothesis, which would be specific risks to single stocks or different securities. So we can rule out C. For B, following a strict buy and hold strategy, this is going to generally be a part of the efficient market hypothesis, but when you're looking at different asset classes and whatnot, we certainly can rebalance. So it's not going to be a strict buy and hold strategy. If we have a certain amount of money in equities versus bonds versus cash, for example, we're going to want to rebalance back to those targets as the assets move in different ways over time. And that's going to leave us with A, diversify the portfolio. This is certainly what we're going to want to do under efficient market. Essentially, we think that securities incorporate all prices. However, it still makes sense to diversify across different asset classes, and we don't want to be picking the securities within each asset class, but we want to be diversified. Answer A. Which of the following statements is most likely accurate? A best effort offering is the most common type of offering. That's going to be incorrect. A best effort offering is not the most common. The most common is actually going to be an underwritten offering, which we're going to learn more about in this next answer here. So we'll cross off A. For B, in an underwritten offering, the underwriters buy an issue and then attempt to sell the issue to investors. This is going to be an accurate statement. And the reason it's the most common is because it puts a lot more of the risk on the underwriter. So the underwriter is typically an investment bank. And so the investment bank is going to buy the shares from the company, essentially. So the company is getting a set amount for going public, for example. So because they're getting a set amount, that's attractive to them because then they know how much capital they're getting and they don't need to worry about it being a variable amount. So the investment bank then is assuming a lot of this risk because they're buying the issue and then assuming that they're going to be able to sell that at a higher price to other investors. And then C, in a best effort offering, the underwriters buy an issue and use their best effort to sell the issue to investors. This is going to be incorrect. They're not buying the issue in this case. They are making their best effort to sell it, but they're not buying it and taking on the risk. They're only doing that in an underwritten offering. Answer B, efficient market portfolio managers are least likely to. So what am I least likely going to do if I think the market is efficient? Am I going to A, limit transaction costs to a minimum? We can rule this out since that is something we would do if we believe in the efficient market. If we think that markets are efficient and we can't outperform by stock selection or doing other things actively, then one thing we can do and control is limiting the amount of transaction costs that we have by limiting our trading. Answer B, devote more time working on security selection. This looks like it'll be our answer, since if we think markets are efficient, we're going to want to devote less time to security selection, not more, since under this philosophy, we think that picking stocks is not going to outperform over time. And C, devote more time to better understand their clients' preferences of risks. We can rule this out as well, since similarly to A, if we think that markets are efficient, we don't want to do security selection. We want to do things that we can control, like limit transaction costs and make sure that our risk is aligned to goals. Answer B. Dylan Farmer is an active portfolio manager who uses an industry rotation strategy. How should he most likely treat stocks in a cyclical industry during a contraction phase? So industry rotation, meaning that the strategy is rotating in and out of different industries based on the economic cycle. So we have the economic cycle that's kind of going like this, up and down, up and down. And so the contraction phase is one of these phases right here. So we hit our economic peak and then the economy is contracting and going down towards the trough. So when we're talking about cyclical industries, their sales and earnings are going to be very closely tied to the economic cycle. So during the boom of the economic cycle, these types of companies are going to do really, really well. But then during the contraction phase, they're going to do a lot more poorly because they're very tied to economic activity. So if there's slow economic activity, they're going to do worse than the overall economy. So if they're going to do worse than the overall economy, they're likely going to also underperform in the stock market. And so if we think they're going to underperform, do we want to be overweight, underweight, or maintain a target weight? If we think they will underperform, then we would certainly want to be underweight those industries so that we can outperform. Answer B. The financial details of a transaction are given below. We've got market price per share on June 30th, 2015 at $28, number of shares purchased, and then ending share price 1 year later, June 30th, 2016. And we made a $2 per share profit. Assuming there are no transaction and borrowing costs, the rate of return on a margin transaction for an investor who purchased the stock on June 30th, 2015, using an initial margin requirement of 35%, and the stock price at which the investor would have received a margin call given 25% margin requirement is closest to. So we need to calculate two things here. We need to calculate the rate of return for someone with a margin requirement of 35%, and then the price went up, so we obviously didn't get margin called, hopefully throughout the year. And then what price would we have received a margin call at? So we'll walk through both of these right here. So our return is going to be ending value minus loan amount divided by initial equity. So our ending value is going to be this $30 times 4,000. So we get 120,000. Our loan amount then is going to be based on this margin requirement of 35%. So our loan amount is going to be the $28 times 4,000, which is the initial money that needed to be put up. And then we put 35% up in equity based on this margin requirement. So our loan is on 65% of that value, or 72,800. And then our initial equity is just going to be this 120 minus 7280, which is 39,200. So our return then is going to be ending value 120,000 minus our loan amount, and then divide that by the initial equity, which gets us 1.2041 or 20.41%. So looking at our answers, we get 10.99 return, 20.41 or 20.41. So we can rule out A. Now we need to calculate our margin call price. Margin call price is going to be original price multiplied by, and then in parentheses, 1 minus initial margin divided by 1 minus maintenance margin. So our initial margin was 35%, which we used for calculation up here, but again, that's given here. And then 1 minus 0.25, which is the margin, ongoing margin requirement. So we want to make sure we have these in parentheses. So we're going to do 1 minus 0.35 divided by 1 minus 0.25 first, and then multiplying that by $28. So we get a margin call price of 24.2667, which is going to be closest to answer B here, 24.27. The stock's limit order book is as follows. So we have bid size and offer size, and then the different prices here. If an investor places a new sell limit order for 150 shares at 26.32, the limit order is most likely said to be. So we're going to be on the offer side then, since we're offering more shares. And we are below the current offer of 26.35. So that would be a better deal for the person on the other side of this trade, because they're going to be buying at this price that's lower than the current book. So what is this said to be? An iceberg order? It's not going to be an iceberg order, since an iceberg order would be showing a small part of our order and then ordering later, which is nothing, and then putting more shares in later for order. But there's nothing mentioned about doing that here. So then we have either behind the market or making a new market. To be behind the market, we'd have to be offering up here above the limit price. And we're behind the market essentially because we're not going to get executed at that price likely. But since we are more competitive than all the other prices currently, we would say that we are making a new market. And so essentially the others on this offer side may have to make their offers better because we're coming in at lower price. Answer C. An analyst is reviewing a company's financial statements and notices that its disclosures about operating costs are less detailed than its revenue disclosures. Consequently, the analyst must use broader, less specific forecasting tools. Which of the following is most likely an example of a broader forecasting tool the analyst might use in this situation? So broader meaning, as it says here, less specific. So we're going to be looking for an answer that's a more broad description or detail for this forecasting tool. So we've got A, costs separated by different geographic regions, B, detailed breakdown of costs for each product line, or C, consolidated financial statement lines such as cost of sales. So between these three, C is obviously going to be the least detailed, It's just giving the normal financial statement lines. Whereas here we have detailed costs of each product line. That's going to be much more detailed than the consolidated financial statements. So that rules that out. And then C, similarly, costs separated by different geographic regions. We're going to rule that out as well. Under these consolidated financial statements, this cost is likely just going to be lumped under one thing, and then we would have this as the greater detail. So to go more broad, we need the broadest answer, which is going to be C.